Hi, this is Chris. I'd like to talk about the toughest type of firm to value, and that's a financial service firm. In general, there are four types of financial service firms. The first type is a bank or a credit union. These are firms that tend to make money by raising money at a low interest rate and lending out money at a higher interest rate. The difference between those rates is basically their profit. A second type of firm is an insurance company. Insurance companies make money two ways. They take in a premium, and they also make money off of investing the premium and earning a return on that investment. Of course, they have to pay out losses associated with insurance claims, and that's one of their major expenses. A third type of firm is an investment bank. Investment banks serve as consultants to companies who want to raise money, who are involved in mergers and acquisitions and need advice or valuation services. Another type of firm is an investment firm. They manage money often, and these firms can earn money through commissions, or they can earn money from taking a fee for asset management. My goal in this video is to first talk about why financial service firms are different, and they require a different approach to valuation. And my second goal is to give you an overview of the four ways in which you can typically value these firms and to provide an introduction to the excess return model. So there are four main differences between financial service firms and regular firms like a manufacturing firm. They're basically three C's and an R. Capital structure, Capex, working capital, and regulation. Let's talk about the first one, and that's capital structure. Debt tends to be more of a raw material for financial services firms, particularly banks. Capex is quite different, in large part because these financial service firms have large intangible assets. These typically are shown as operating activities on the cash flow statement, and that results in low Capex and low depreciation. And just think about the formula for free cash flow. These are very important parts of the free cash flow formula to equity, Capex and depreciation. And here, you don't have as much of them. 3, working capital. Current assets and current liabilities, that's CA and CL, tend to be large percentages of the balance sheet for these financial services firms. They tend to be volatile, and the investment in working capital doesn't have a close relationship with the growth of the firm as it does in a traditional type firm. These organizations are highly regulated, among the most regulated in our entire economy. And the reason why is, of course, because if they go down, they tend to need to be bailed out, and there are public costs associated with these bailouts. So the regulatory issues are very important because regulators are often going to require a minimum amount of capital, and that's basically an investment for the firm. Before I talk more about these differences, I want to talk about the approaches to valuation. Here's a menu. You have 4 things that you can choose from when you're trying to value a financial services firm. And I will argue that in most cases, I side with just using two of these 4. When you're approaching valuation, you typically want to approach valuation by valuing the equity in the firm as opposed to valuing the firm as a whole and then subtracting off debt to figure out what equity is valued. With a traditional company, either approach tends to work. You can value the firm, you can value equity. Generally, you get to about the same valuation for the stock price, but that's not the case here. And we've already discussed why. Because debt is different. Debt is often a raw material as opposed to a source of financing for a financial services firm. So in that case, debt is a little more ambiguous than it is for a traditional firm. So taking this firm valuation approach, then subtracting off debt to get to the equity valuation doesn't work as well. So when you're looking at these approaches to valuation, note that these are all taking this approach of trying to value the equity in the firm. The first approach is the dividend discount model, that DDM. What this does is it values the dividends that go to the common shareholders. This doesn't really need to be discussed in depth, but this is often a very good approach because Many financial service firms pay high dividends, and this approach tends to work pretty well. Another approach is to have a discounted cash flow to equity approach, but there are two general costs that you have to adjust for. You have to capitalize the employee development cost. These are the types of intangible assets that are often unique to the financial services firms. They invest a lot in their employees, far less in the traditional property, plant, and equipment. So these costs tend to be classified as expenses. These expenses are viewed as operating activities on the statement of cash flows, and therefore they result in low Capex and low depreciation. The second adjustment that you need to make when you're choosing approach number 2 is you often have to account for the capital required by regulators. What type of capital is the minimum amount that regulators are going to require? Regulators tend to look at financial services firms, and the capital is viewed not as equity plus debt, but it's generally viewed just as the equity or equity-like financing that a firm uses. Approach number 3 is the excess return model, and I'll talk about this in depth. This is my go-to approach if you're going to use a discounted cash flow model in order to value a financial service firm. I think that number 3 works generally better than number 1 and number 2, but if you're going to use relative valuation, you're generally going to use either a price to book ratio or a price to earnings ratio. Enterprise value to EBITDA does not work as well. The enterprise value to EBITDA ratio includes debt in the numerator, and remember, debt is more of a raw material for these financial service firms, and it can be hard to identify. And in the denominator, it subtracts out debt payments. It's taken out of EBITDA. One of the primary expenses associated with a financial services firm is this interest payment on interest-bearing liabilities for the firm. So it's ignoring one of the major costs. This ratio just doesn't work as well. So to summarize, if I was going to use a discounted cash flow approach to value a financial service firm, I would choose approach 3, that excess return model in general. Certainly some cases where number 1 is going to work well. If I'm going to choose a relative valuation approach, I prefer to use the price to book ratio. Again, it's not going to work perfectly for all firms. The PE approach is going to work for many of these firms, but price to book should be your go-to ratio. So let me talk a little more about the differences between financial service firms and other firms. As I mentioned, debt is a raw material for financial institutions. Financial institutions will raise money by allowing people to open savings accounts and checking accounts, and then they will take that money and try and invest it by loaning it out to someone. A loan may be a liability to a person, but it's an asset to a bank. It's an investment to a bank. Think about it this way. If a customer walks into a bank and deposits $1,000 into their checking account, should this be viewed as the bank taking on $1,000 in additional debt? A better way to view it is to view it as raw material for the bank to turn into earnings. They can take that additional $1,000 and loan it out to a customer at a higher interest rate than they're going to be paying on that checking account. Capex is another important difference. Capex for most firms is going to be an investment in property, plant, and equipment, PP&E. For financial services firms, they certainly have some investments in property, but they don't have as large of a percentage of their assets invested in PP&E. Financial services firms tend to make large investments in intangible assets, things like their brand, things like their employees. These are shown as operating expenses in the accounting statements, and the cash flow statement shows little Capex and low depreciation, which makes using the free cash flow to equity formula a little different than it would be for a traditional firm. Another difference is going to be that of working capital. So when most firms grow, they need to invest in additional working capital. Maybe they open a new store and they need to invest in additional inventory. It's different though for a financial services firm. Current assets and current liabilities can be a very large portion of a financial institution's balance sheet, and these changes in working capital are often large, they can be volatile, and unrelated to growth. So it's very different for these financial services firms. Let's talk first about GAAP earnings. Here's the traditional approach to measuring earnings. And the reason why I'm talking about this is to provide an intro into the excess returns model. When you understand what's going on with the traditional measure of earnings, then you can move forward and start estimating the excess returns. The income statement includes a charge for debt. This is, of course, the interest expense, but it doesn't explicitly include a charge for the cost of equity. And there's a reason for this. The reason why is because the expected return on equity is very hard to measure. And if you would have something that would differ depending on which accounting firm you went to, if there's a lot of professional differences in the approach, accountants really don't like it. They value reliability. So regardless of which accountant you would go to, you're going to get the same result. Cost of equity is incredibly hard to estimate. So what happens is companies can have positive net income but still not be creating value for shareholders. And the reason why is that their return for shareholders is not in excess of the expected cost of equity, which leads us to the definition of excess returns. Residual income is net income less a charge for common shareholders' opportunity cost in generating net income. Residual income explicitly deducts an estimated cost of equity capital. So think about a bank in this way. Banks, as I mentioned, raise money by allowing people to open checking accounts and savings accounts. They pay a low rate of interest on those accounts. Then they turn around and loan it out at a higher rate. You can think about excess returns in this way. Companies will go out and raise funds and pay a capital charge on those funds. Hopefully they'll do it at a low rate, and they'll turn around and invest in assets at a higher rate. And therefore their return on investments is going to exceed their cost of capital. That's how they create value, which leads us to a model of excess returns.